Joining us to talk about that from the CME Group is Trey Knippa, owner of Lotus Brokerage Services. He actively trades index futures, currencies, and some commodities. And in Boston, Christopher Sheldon, Director of Investment Strategy at BNY Wealth Management. He helps oversee more than $150 billion in assets. Let me ask you guys, and Chris, I'll start with you. Are you concerned that we're kind of reaching an inflection point here, that we've kind of topped out in this market, at least for the short term?
Well, if so, only for a very brief period of time. I think you really have to put today's moves in the context of how strong the markets have been and how much good news they've discounted since the end of August. So I really think this is just a pause to reflect and consolidate a little bit. But I think the economy is getting better. So, 2011 looks like it should be reasonably decent, I think.
Hey, Trey, Adam mentioned before that our buddy over there in Chicago, Andrew Keene, wants to buy on the dips. Do you think a lot of people are following that strategy? Because it doesn't feel like it today.
Sure, obviously today being the exception, but let's forget, I come from a cattle background. I grew up in Texas, and you always have to remember, you have to feed a bull. And I think today we've kind of gotten caught up in the idea, what more bullish news are we going to have coming at this market, at least in the near term? So investors got a little scared, and we've had a setback. I don't think that changes the broader landscape, because one big factor here is going to be the dollar and what we expect out of the dollar. As far as I'm talking about current commodities now especially. So is this an opportunity to buy these hard assets on this big dip? And unless we see some big major change in dollar policy, then the answer is yes, this probably is a buying opportunity in commodities.
Hey, Trey, it's Julie here. What else are you going to need to feed this bull in the near term? Because we're pretty much at the end of earnings, for example. What's going to be the next catalyst?
That's a great question, and what I use, clearly this is, in some ways, this is art, not science. Different traders do it in different ways. What I watch when I'm trading stock index futures is I look for leadership in the NASDAQ. And today, right after we opened, the NASDAQ tried to rally and tried to lead the S&P back up, but then when the NASDAQ rolled over, it was all over. So I think you're going to need to see some positive news coming from the NASDAQ side of the market in order to get us to kind of bottom out from this pullback and work our way back higher.
All right. So what's the next focal point, you guys, for the markets? Chris, let me throw it out to you. We got through so much stuff. We've got the markets taking a little bit of a breather here. What are you keeping an eye on?
Well, I think right now the market has anticipated a reduction in the uncertainty. Now we need to see the follow-through. We do need to see some compromise on the discussion of the tax extensions. We need to see what happens here with the shakeout of quantitative easing. So I think, to me, because you're not guided now by earnings, you actually need to see some follow-through on what the market has come to price in there. So I think it will be natural to see a little bit of these fears that have been talked about, but I think the reality is, as people settle down, I'm actually surprised the market held up as well as it did in light of what you might have walked in thinking this morning.
Hey, Chris, it's Adam. If you look at the 10-year, the yield moved up to about 278 today. That's quite a move today. And, of course, QE2 began today. You think the market's disappointed? Like, did it not get enough sugar?
Well, I think in some ways what happened is the anticipation of quantitative easing starting back in August is what the effect was. So, I mean, clearly inflation expectations have risen. I think the market felt like maybe there'd be more purchase on the long end of the maturity range. So maybe a little bit of a disappointment, but I also think it's the recognition that inflation seems to be, percolating up a little bit more than this fear of deflation.
Hey, Trey, I know one thing you're worried about, and you said next week, is we got to worry about the sovereign debt war, Europe specifically. I think about what's going on in Europe. How much talk is there on the trading floor about the concerns in Europe at this point?
Oh, especially in the agricultural commodities, that doesn't occupy the biggest part of our discussions. However, when just kind of looking at the broader market and some talking to people that I talk to regularly in markets, I think that the sovereign debt notion, that sovereign debt discussion will continue to stay kind of on the front page of the paper, if you will. And I think more and more focus will go towards it. I know I've been doing more and more research trying to find ways that I can take low risk bets, if you will, against some sovereign debt, because I think it is a real worry, and it may represent one of the larger risk-reward trades that one can make right now.
How worried, and what impact do you think it could ultimately have on the markets, the overall global market situation?
Well, right now, everybody's just focused on Europe. And obviously, the big notion right now is Ireland. People are talking about that, talking about what they're doing to try to square away their debt to tax revenue situation. But I think that this notion of sovereign debt issues and sovereign debt worry will work its way over towards Asia. And when it works its way over towards Asia, I think it's going to be a lot bigger impact than it has been in Europe.
Well, basically, I mean, Chris, bringing this kind of back into the equation here, this idea that perhaps, China is a concern going forward here. How much of this is really about the fact that China, which has been such a huge kind of growing economy, is now, yes, still growing at 8 to 9%, but that's just not going to be good enough for the rest of the economy, globally speaking?
Well, I think the fear is more that because, first of all, the impact of all of this liquidity out there is driving into foreign markets, is driving into commodities. And so if there's anybody fearful of an inflation impact, it's China. So they're taking the steps they think necessary to slow that down. So I don't think it's so much the fear that 8% is not enough. I think it's the fear that by hitting the brakes too hard, maybe that slows down and curtails the global recovery. I don't agree with that. I also think that the sovereign debt is more not as systemic and not as bad as it was back in April and May when it first came out. Then it was a big shock. It was not clear that there'd be a mechanism to deal with it. I don't want to dismiss it completely, but I think it will continue to percolate as an issue. But I think it's just kind of, it will come back and forth at different times as a risk.
Chris, the consumer obviously still makes up the bulk of the U.S. economy, and we're going to have a shopping season coming up.
We had strong confidence
numbers
today.
That's right. So are people looking at that yet? Is that an area that you're looking at? Consumer discretionary stocks as a group have done well this year already.
Oh, yeah, I think there's been a lot of focus there. There's absolutely been a lot of fear. Certainly most people recognize the need for the consumer to save more, to pay down debt. But I think that those fears were so prevalent earlier on this year that there's actually probably room for a little bit of surprise. I'm not saying that the retail year-end season will be great, but I think it could be better than people expect. And so, I think the folks who are looking closely at that expect that there will be an okay year-end to the black season they're selling, but not spectacular.
Hey, Chris, really quick here. How much of that demand has already been drawn forward, though? We've been talking for the last couple of days about this idea of all these sales happening right now. It's no longer Black Friday. It's right now. The whole thing is a sale, right? So how much of that
Take your time. Don't even go quickly.
Right. Well, I mean, investor and consumer sentiment has improved a little bit. We've proven over the last year or two that when you offer sale, they come out. So I won't be surprised to see if there is a bit more demand than people think. I don't think we've fully pulled that away with the current sales. We'll have to see, though.
Hey, let me jump in, Trey. You're going to be talking to the boys come Sunday night and getting fired up for another week of trading. What's on the top of your agenda for Monday? What are you looking to trade Monday morning?
Monday morning, I'm going to watch two things. Number one, I'm going to be watching the euro currency. The euro has actually performed reasonably well today. Maybe just the idea that the euro has kind of offered their support of Ireland if their problems persist. And I'm going to watch crude oil. Crude oil has been an awfully good indicator of what's going on in stock index futures. So if crude oil can't really recover, see some action in the forward spreads where the front months of crude can gain on the backs and see a little bit of recovery, then I'm going to probably be more interested in selling rallies in the S&P futures rather than buying breaks. But if the crude can recover a little bit, then I may turn buyer.
All right, guys, we got to say goodbye. Trey Knippa, Chris Sheldon. Guys, thank you so much. Have a wonderful weekend.